Hi guys, welcome back. I recently saw a video from Joseph Carlson where he talks about small cap stocks, how the media exaggerates their value and just generally makes a case against them. But I think he's wrong. So first, let me make clear that I find Joseph's videos amazing and I don't want to hate on him. Generally, I also like his investment strategy a lot and, in fact, it is largely very similar to my own. He is looking exclusively at American large cap stocks while I try to diversify more globally as well as market cap wise. But the properties his investments have to bring are largely the same as the ones I am looking for. I also think that he's right with the fact that the media is currently exaggerating the value and importance of small cap stocks. But then he is doing exactly the same, just in the opposite direction. So in this case, I strongly have to disagree. Listen closely to what he says here.
After years of the market being pushed higher and higher by large cap technology companies, ones like the Magnificent Seven, ones like big tech companies, it now seems like some investors are concerned that the rally can't continue with these stocks, that instead we need to look for returns elsewhere. We're now seeing a concerted effort from the media to push small cap stocks. The Wall Street Journal says why now may be the time to invest in small cap stocks. Bloomberg says that small caps rise as big tech takes a back seat. Barron says that small cap stocks are finally ready to run with the bulls. Is it finally time that we switch to small cap stocks? That we give up on the market leaders, the biggest and most powerful companies in the world? Well, in my opinion, no.
He goes on saying that, and I quote here, he believes that the pressure the media is putting on investors to sell out of large cap stocks is misguided. So, first of all, that is not at all what the media and the articles he quotes are even saying. I did a bit of digging to find the articles he mentions in his videos and put the links to them down in the description below, so you can check them out for yourself. Unfortunately, Joseph does not provide the sources in his videos. And actually, in none of the articles is even a remote recommendation to sell out of mega or large cap stocks and switch to small cap stocks. That is not what the professional advisors recommend, and that is not what I would do. I would even argue that it's never time to switch to small cap stocks. Instead, small cap and mid cap stocks should be part of your investment strategy from the beginning. But I think that his argument and the similar thinking of many investors comes from the fact that many don't fully understand or know what small caps are, what the risks with small caps are, and when and for whom it still makes sense to include them to their portfolio. So today I'll go over exactly that. I'll have a look what small caps even are, the specific risks and benefits they offer, how experts suggest structuring your portfolio, and the ideal proportion of small caps to include. Last but not least, I'll show you some options on how you can invest in small cap stocks with low effort, and also my concrete criteria that I use for choosing individual small cap stocks for my portfolio. First, we need to understand what small caps even are. And the answer is not as simple as it first seems, because there is no concrete and universal definition. The cap in small cap stands for market capitalization, of course, but every broker can have slightly different definitions of the exact limits here. Usually, it is around the values as also defined by Investopedia, from around 250 to 300 million on the lower side to roughly 2 billion on the upper side. Besides the market cap, small caps can also be defined as generally younger companies that are growing fast and are looking to become mid or large cap stocks in the future. Contrary to what some seem to believe, they are not startup companies though. In reality, there are many small caps that have well-established businesses with long track records and great financials. Just look at the companies in my Small Cap Sunday videos that both have been on the market for several decades already. They are also not limited to any sector, but can be found all across the market. In fact, there are more small caps companies in the market than large cap and mid caps combined. So if you exclude this whole group from your portfolio, you're actually also excluding most of the market. Despite the small size, there are still smaller companies out there with penny stocks that usually have a stock price of below $5. Because of this unique characteristics, investors in small cap stocks have to look out for other risks than large or mega caps, but they can also benefit from unique advantages. On the risk side, we have, for example, a much lower trading volume and much less outstanding shares of a company compared to larger caps that leads to a higher volatility of these stocks. That is basically just a fancy way of saying that they can experience rapid swings to the up as well as to the downside. This also makes them especially vulnerable to economic downturns or bearish sentiment on the market. This sensitivity, combined with the limited access to investment capital, also makes them more risky in general and more vulnerable to interest rate changes. Basically, it is easy for smaller companies with less money to get into financial troubles than a large company with many assets and a large balance sheet. Another special risk, or rather drawback for investors, is also that information on these small caps is often not so easily available on the respective sites, and they are also not covered by so many analysts. So it is harder to find out if the company is good or not, and the research can be more time intensive. But this time investment can pay off, as on the plus side, this lack of information can give you an easy edge if you did your own research. It is much easier compared to large caps to get an edge with your own analysis here, exactly because the data is not so easily available and researched so often. This can give you an advantage even against fund managers. They are usually restricted in their investments with the size of their portfolio, their investment rules, or the amount of money they need to invest to even have an impact on their performance. This limitation can often exclude small cap companies altogether from such funds if they are not specifically targeting them. The next advantage is that small caps tend to have a quicker growth and outperform large cap companies, especially over the long run. Looking at the blue bars here that show the outperformance of the MSCI World Small Cap against the regular MSCI World, the MSCI World Small Cap Index could outperform the regular index in every time frame measured between 1975 and 2023. That's a research time of almost 50 years. And the longer the observed time is, the stronger the outperformance of small caps becomes. But please keep in mind that this is a long-term statistic. So there can be shorter time frames where large caps still outperform small caps, like in the last couple of years, for example, where a large portion of the overall market gains have been dominated by just a handful of mega caps. One reason for this long-term outperformance is actually my next advantage, and this is a lower share price and, at least at the moment, also a lower valuation that makes an initial investment in these stocks much more affordable for smaller investments. And this is a special case right now, as over the long run, the valuation of small caps is oftentimes higher than that of large cap companies, as this graph shows for the time frame between 2009 and last year. Last but not least, if you exclude small caps from your portfolio altogether, you are excluding the largest portion of the market too. And I would argue that this has nothing to do with a well-diversified portfolio at all. It probably has more to do with either a lack of understanding of small caps, as they are discussed much less than their larger counterparts, or, and the second part is definitely a point I can't understand very well, the lack of willingness to invest that much time to do your own research in this intensity. After all, as I said, information is hard to come by, and the vast galaxy of small caps might make it seem like you're looking for a needle in a haystack. Small cap ETFs could be a solution for this, but I'm getting ahead of myself here. First, if you have decided that you want to have a real diversified portfolio and include small caps, the question comes up, how should you structure your portfolio? And how many small caps should you include? Of course, this depends very much on your personal preferences, but the AAII, the American Association of Individual Investors, has a very concrete suggestion for this. They have 3 models here for investors with different risk profiles. And the first thing that is different, but not very obvious from this table, is the total portfolio allocation in stocks. While their suggestion for aggressive investors with a higher risk tolerance is to allocate 90% of their portfolio into stocks, they only recommend to put 40% into stocks to more conservative investors. They recommend putting the rest of the money into fixed income generating assets like bonds, for example. These recommendations are not only linked to the risk profile, but also to the age of investors. Because younger investors have more time in the market and can more easily outweigh any weaker market cycles compared to older investors, and therefore usually have a higher risk tolerance in general. What is interesting though is that they always recommend putting around 20% of your capital in large cap stocks. But depending on the individual requirements, the recommended allocation of small caps, mid caps and international stocks is shifting. Similar to small caps, these stocks in general have a higher risk and volatility, but with a historically higher rate of return. And we can see this in the average annual growth that they estimate for aggressive portfolios with around 8%, while it is only 6% for conservative investors. But they also warn that the potential year-to-year volatility is substantially higher in this case. For small caps specifically, they suggest a maximum allocation of 20% of the total portfolio. So as long as you're not drawing money from your portfolio and you don't need it to provide a regular monthly income, the clear recommendation is to allocate at least some percentage of your portfolio to small caps to increase the returns. My own allocation in small caps and mid caps is currently around 10%. So I might even try to increase this over the coming months. Overall, I am rather a defensive investor, but I still think that it would be a big mistake to exclude this whole group from my portfolio from the beginning. But what if you would like to include such stocks to your portfolio, but the hassle of screening thousands of small cap stocks and searching the web endlessly for information seems a bit overwhelming? Are there any possibilities to make this any easier? Well, luckily the answer is yes. First, you're watching this video, so you might also have seen some videos from my Small Cap Sunday series already, where I try to find new small cap investment ideas. If not, feel free to check it out after this video. There is also a lot more to come soon. And while you're at it, please don't forget to hit the like and subscribe button. It doesn't cost you a thing and really helps me out a lot. So thank you so much. But if you don't want to deal with individual stocks, there is also the option of using a designated small cap ETF. And there are several options for this out there. The most famous of all is probably the Russell 2000 index. It has been around for a very long time already, namely since 1984, and it is maintained by FTSE. It focuses on small caps only from the US and is made up of around 2,000 of the smallest companies from the Russell index. It is by far the most common benchmark for small caps. Over the last 10 years, it could produce annualized returns of 8% per year. And there are many ETFs out there based on this and also the next indices. I don't want to go into too much detail here, as this would be too far from today's topic, but if this is something that would be interesting for you, please let me know down in the comments. I'd be happy to dive more into the details in a future video. The next index is the S&P 600 index. This is an index from S&P Global and, same as its big brother, the S&P 500. It is a capitalization weighted index, only this one consists of 600 smaller cap companies from the US. That means that these companies that are included in this index are weighted according to their total market value. This index is not a pure small cap index, as it includes companies with a market value between $1 billion and $6.7 billion. But in addition to this, there are also other qualitative requirements that a company has to fulfill to be included. The index was launched almost exactly 10 years after the Russell 2000 in 1994, and over the last 10 years could produce quite a bit better returns than the Russell 2000 with 8.1% annual returns. Last but not least, I have the MSCI World Small Cap Index. This captures more than 4,000 small cap stocks from 23 developed countries. It does not include companies from emerging countries though, and the largest chunk is still made up of US stocks. Its target is to cover around 40% of the market capitalization in each covered country. So it is by far the most diversified index of them all. It was founded in the late 2000s and could deliver annual returns of around 7.4% of the last 10 years. So the recent performance was the worst of the three. But this can be partially explained with a very strong performance of US stocks in general over the last decades. And these are just some examples of small cap ETFs that could be used to spice up your portfolio. But if ETFs are not your tool of choice and you're fine with doing some research and choosing individual stocks for yourself, I'd like to show you my concrete selection criteria for choosing small caps for my portfolio now. These criteria are not very different from the ones I use for my large cap investments. The most important one is that the company needs to earn money and be profitable. So for me, it is mandatory that the revenue as well as the operating cash flow are positive and growing. Generally, I also like to have a positive free cash flow. But I'm willing to make exceptions here depending on the nature of the business and the company's stage of development. For instance, significant investments or acquisitions that temporarily push the free cash flow into the negative could be a reason for an exception to this rule. These are by far the most important parameters for me, and I will never invest in a company that is still losing money. So, same as for large caps, I am looking to find already profitable companies that are growing and producing cash for their investors. And speaking of growth, the growth for these investments should be larger compared to large caps to compensate for the increased risk. So I am looking for a 5-year average growth numbers that should at least be in the high single-digit range, but preferable even double-digit. I always start by looking at the 5-year average values because I find as a long-term investor they give me a better indication and are not affected so much by short-term effects. The next criteria is that I'm looking for companies that don't have too much debt on their balance sheets. This reduces the potential impact of any macroeconomic changes like interest rate changes, for example. The value I'm looking for here is the same as for large caps. A long-term debt to EBITDA multiple of not more than 3 times. I'm also looking for companies that are not diluting their shareholders. So I am looking for an annual share dilution of under 1% over the last 5 years. In this case, I also might make an exception though if it was due to a bigger acquisition or so, but in general, I like my companies to buy back shares or at the very least to keep it stable. These parameters are all easily and quickly to measure. What is not so easy to measure, but at least equally important to me, are the more qualitative aspects that I'm looking for. And this is something that many investors seem to forget. When you look at many stock analysis YouTube channels, many of them are just looking at the numbers. But this is just part of the picture, and the more qualitative aspects are at least as important as just looking at the numbers. This is double as true for small caps as for large caps, as I want to make sure that they already have a proven and good business model that works. For example, I am looking for companies that are operating in a non-cyclical industry and, if possible, have a proven track record that also spans different economic cycles like recessions or higher inflation. This way, these companies have already shown that they are capable of surviving tougher circumstances and have a resilient business model. I'm also looking for companies that are operating in a market with secular trends to help them grow. It is always easier to swim with the current than against it. The last 2 points on my list are not 100% mandatory for me, but are still something that I look out for. For example, I am looking for companies that have something unique going on for them. This could be a special business model or a unique product or even a unique approach to doing their business, like, for example, the mixed business model of Energiekontor that I described in my analysis of them. Basically, it is something that sets them apart from their competition and gives them a moat or at least some differentiation from their competitors. Last but not least, I'm also looking for a reasonable valuation. That means for me that their valuation shouldn't be much higher than their own 5-year averages and also the sector medians. If they pay a dividend, I also like to compare the dividend yield with their long-term averages to see where it sits. I am not looking to buy cheap companies here, but I'm trying to avoid hype stocks and vastly overvalued ones. So here you are. These are my 2 cents about small caps and why and how I like to include them in my portfolio. If you are looking for some concrete small cap stocks, feel free to check out my latest video in my Small Cap Sunday series right here. And please let me know your thoughts on small caps down in the comments. I would be really interested to hear if you have included small caps to your portfolio. And if you have any stocks that you would like me to take a look at, please feel free to also post them under the video. I can't promise anything, but I'm trying to analyze as many of your recommendations as possible. That being said, thank you so much for watching, guys, and see you in the next video.